When I was broke, I had rich habits. When I was broke, I had rich habits.
All right, welcome to the Master Keys podcast. I'm Chandler Halliburton.
I'm Neal and
And it is, man, we're coming up on mid-June. I don't know what episode this is. It's the second season. We're going to cover a few things today. Obviously, there's chaos going on in the world right now in the financial markets, the real estate market. But we're going to look at a few things. Other affordability indicators. We've talked a lot about inflation, but let's see what that actually is yielding when it comes to data. And then some possible signs of the economy slowing, because we've talked a lot about how the Bank of Canada's intent is to bring down inflation, which means slowing the economy. So what signs can we see out there of that happening? And then we're going to talk a little bit about what an appraisal is, how an appraisal works, because they're becoming increasingly important in this current market.
Yeah, and one thing I want to talk about just before we dive in is Master Keys podcast. The objective of our podcast was to help people get educated a little bit more on real estate, kind of what's going on. We are by no means financial advisors, but we are just trying to create a resource for people that can kind of help them either get in the game, do better at the game, or even just hear some interesting stories and kind of sentiment on the market. We found it really hard to find resources for that, and so we're trying to create that. And we've mentioned a few times before, we're going to be creating some more intensive content on Patreon. We're going to have a website coming where we'd like to have some spaces where everyone can go and share some things that they're doing, get questions answered, and there'll also be some resources on there. So again, thanks for tuning in. Master Keys Podcast is trying to help out. We appreciate you guys listening. But yeah, like to what Chandler said, we're going to dive a little further into some things about inflation, kind of what the banks are saying, and the general market sentiment today.
And I want to add to what you said there. Recently, we've been, out and around. The weather's getting good. So we've been going outside, seeing people. And, a few of you come up and introduced yourselves and said hello and mentioned enjoying the content. So we really appreciate it. Yeah. We find it not only flattering, but just rewarding to know that people are checking it out. And, leave questions, leave comments. They actually changed the icon or the graphic for the like button. So go ahead on this YouTube video and try the like button.
I haven't seen that.
Thing. Yeah, like, follow, subscribe. So check it out. Click it. Awesome. What's going on, Neal? What's new?
So again, this is funny. This is my new thing. Every time I say not too much and nothing really exciting, and it's because I've mentioned many times my nervousness of the market. So I've been really
coward.
I am a coward. I am really focusing on accomplishing and finishing all of the projects I bought. I've mentioned a few times I probably have about 7 or 8 buildings that are half torn to pieces. So we're putting a big push on getting those accomplished. And the reason being is kind of with rates going up, it has impacted the amount that the
takeouts. Got to get that cash flow coming in, man.
Exactly. Cash flow needs to come in, and it's going to impact the takeout. So the longer I wait, the longer anyone waits, it could potentially reduce your takeout down the road. So I'm really focused on trying to get those finished. I have been looking at a couple different projects. A few that I'd mentioned on previous pods have rolled across the table again, and we're kind of struggling to meet on price points. Mm-hmm. So I'm hoping if I can lock this one up. I'm not saying it on the podcast again until I have it finalized.
I think you need to buy something purely for the sake of the podcast, because honestly, man, you're running a little thin on content. So you need to purchase something just for the podcast.
I need a make work project. I do have a couple places that I'm going to be listing, I think, to sell. Maybe not necessarily directly for me, but through people that have invested through me. But yeah, I haven't made a purchase. I feel so weird. This is the first time I feel like I don't have a property closing for a while. And it's really because I'm just not 100% sure how I feel about the market and exactly what my path moving forward is going to be.
So
what do you got going on? I know this is the whole opposite. Chandler's like, I got 47 properties under contract.
No, I mean, like you, so the other day I dropped off a check for like $42,000 to my contractor, and this was on the heels of a check last week for $25,000, and the market's slowing down a little. Yeah. And I kind of was like, hey man, we got to get some of these units finished because I need some of the rents and I need to get on my refi. So I'm feeling that strain a little bit as well. I think everyone is. I need to get those units finished. But I am closing on another property, I think less than a month from today. Nice. That's 12 units, and that's going to be a project starting right away. And I've got another deal on that collection of properties, which ends up being about 5 units, but piecemeal between different things.
I'm going to cut you off. I just thought of something interesting. This is how interesting my life is.
This is going to be good.
We're converting some of our long-term rentals to Airbnbs.
Yeah.
And so I'm going to take you guys all through that journey. I have done no Airbnb to date. These are fully renovated units that were previously rented for 1 year long term. We decided to Airbnb them due to the fact that they're in a neighborhood which, when I scroll through Airbnb, you can put no dates, no specific location, and it just gives you all the listings in that area. And there was a fair number of listings, but then if you look at the dates, you can also see how far out they're booked. The earliest I could find for another 2-bedroom Airbnb in that neighborhood was October.
Yeah, I know you were saying that. That's crazy.
And then Airbnb also offers, and I've talked about this before, is you can put in all the parameters of your unit, like the amount of beds, finishes, whatever it's got for features, and see what they project based on that address for rent based on the ones around you. And so I was renting these units for $1,450 plus heat and power, and Airbnb is estimating $6,000 a month for Airbnb revenue. So once I boil out the fact that I got to pay utilities, pay for the
cable.
furniture, pay cable, and pay a manager, it's still, I think, going to work out to probably be closer to $2,000 or $2,200, which should be about a 25 to 30% uptick on the rent, which for me is worth it. And it just more for me, it's honestly the experience. I really want to try getting into the Airbnb.
It's also diversifying. Like if people are saying there's some risk element to, long-term renting right now with the rent cap and inflation, all this.
Yeah.
It's kind of, lessens your exposure there.
Yeah. So I cut you off.
No, it's all right. It's actually related because I'm going to do the same with some of these units I'm acquiring. Additionally, we just filmed some content down on the South Shore that's going to be coming out in the next little while. But my first Airbnb venture, which is down on the South Shore, maybe more traditional Airbnb market. So.
But the other thing, I guess, I'm doubling down on my concern of this market. Like I'm going to be flipping a bunch of my different things. I think that on the luxury side. So like my vehicle, I think I'm going through a flip now because like I've said, I think the vehicle market might change a little bit and there might be some pullback on certain cars. And so I'm hoping to make an exit on my vehicle now and potentially get into something that won't have as much of a depreciation hit. I could be totally wrong because production numbers are going to go on. And I know people are saying like microchip shortage will remain, especially where Ukraine is one of the biggest producers of neon gas, which is required in microchips. And obviously things haven't gotten any better over there yet. So there is potential that it continues like this because the wait list for a lot of these higher end semi-exotic vehicles continues to grow. But again, as we talk more today, I think you'll see why I've kind of changed my mind on boats, vehicles, and some luxury goods in the short term.
There's some other, just to return back here, like hyper local, thinking about like what's going on with us right now. Pretty awesome cruise ship out there.
There is a pretty large cruise ship out there. It's Oasis of the Seas. I'm sure many of you have heard of Oasis. I think it was only built like 5 years ago or something, and it was the biggest at the time. I believe. I'm going to get corrected on that. I can almost guarantee my life on it. But it 8,000 people roughly, I think. And so Halifax isn't an enormous city, but I feel like in any city, when you drop that many people off in like 5 blocks.
I think like their capacity on that particular one is about 6,500, and right now there's about 5,000 plus.
Okay.
Right.
There, so I stand corrected. So anyways, regardless, 5,000 people, and it's a Tuesday and middle of the day, and our downtown is bumping, and you see all we get what's called a harbor hopper. It's effectively a super ugly bus that floats in the water with no top, and
It's
those
an amphibious vehicle.
It's those are ripping around. The little boat rentals are going. Sea-Doos are flying. I see everything. Like I don't even know what this thing is. There's like a wood charter boat going by right now, but it's awesome. This is definitely Halifax, the Atlantic coast. Summertime is
bumping,
the place to be.
Yeah, it's good. It's like something like, how many stories is that thing? I wrote it down here.
17, I think you said, or 18
it's
stories.
Crazy. Like,
I'm gonna go kayak next to it here in a minute.
Yeah, it's a big boat. The other thing I thought was really cool in our local news was you can get rid of your parking tickets. So a parking ticket here is about $35, but if you can prove that you spent $35 at a local store plus or minus 3 hours of the time of your ticket, you can get your ticket reimbursed or waived.
If this incentivizes people, like if you come out and you have a parking ticket and you're like, all right, I'm just going to run into a store right now and drop $40. If someone does that, I'm going to be like, oh my God, I just smoked the mic stand. I'm so excited. This is going to be one of the greatest things they've ever come up with.
Man, it's only going to run through the summer. It's only, I guess, in like the downtown core.
Yeah.
I don't know if it's on both Dartmouth and Halifax, but yeah, if you get the ticket, you're like, man, I'm going to spend $35 anyway. I might as well dip into a store, buy something, and have it go there rather than go to municipalities. So kudos to Halifax for coming up with that. I think it's a great idea. I'm sure it's in the other municipalities. I hadn't heard of it, but I think it's awesome.
Very smart idea.
I also was on the phone with the mayor's office today. I got a call back from a strongly
I was on the
email.
phone with the president earlier.
Yeah, no big deal. Ever heard of him? So I reached out because a lot of people in my neighborhood have been noticing the increased little temporary shelters around downtown Dartmouth. That's where I live.
Yeah.
And I was curious. A lot of people are upset about it. Like,
NIMBY.
you know, people can feel, well, yeah. People do not want them there for all kinds of reasons.
Yeah.
And I reached out, and part of my email was, can you just clarify, are all the current shelters and housing options full? Like, is this genuinely a surplus, or are some people selecting to not stay in those units, but rather live in one of these temporary? And the answer I got was that the existing shelter supply is maxed out, and that some of these new quote unquote temporary things that they made are still not up and running at full capacity. And they also mentioned, just kind of a curiosity, when I was talking to the person from the mayor's office, it wasn't the mayor himself, too big to take my call, but there's also a rule, like, just so you know, if you're curious, they can not be removed. There was actually a court case, I guess the Supreme Court of Canada said that those shelters cannot be removed between 7 p.m. and 7 a.m. as well.
Oh.
Which I was like, I didn't ask, but that's an interesting thing to know, because there was some criticism that this was being done stealthily and so on. But if you're seeing those units in your neighborhood and you're wondering what's going on, it is because even though they have provided more and more units, it's still not meeting the demand at this point in time. So
that doesn't surprise me. But
I'm sure there's some people curious. There are people in my neighborhood curious, hence the email. And that was the reply I got today. But let's dive in. Let's dive in. So we've talked a lot about how things are getting expensive, and I cited that youthful cities. Yeah, inflation. Ever heard of it? That article done by Youthful Cities, and I encourage people to go and check out their website. They've created this think tank called Youthful Cities, and it's got the website. And they kind of rated cities, and Halifax was rated as the most expensive city for people 15 to 29, which was really depressing. But a stat came out, like I was going through the website, and one of the things they highlighted was that people in that age group, again, that's 15 to 29, run a deficit of $750 a month.
what is a 15-year-old spending $750 a month on?
I don't love this this category.
What is a 17-year-old running?
Yeah. Well,
I am sure there are 17-year-olds out there that are having to support themselves, but I don't know that it's...
Of course they're running a deficit. They make no money. But,
anyways, I know. And then so realistically, it's the 20-year-olds that they're talking about. They're graduating and they're running a deficit. That's the other problem that kind of skews this statistic is 18 to 23...
Could actually be higher. Yeah,
is likely quite a bit higher because they're university students who don't have an income, but then also spend about $20,000 a year to live.
Yeah, that's true.
So they're a deficit of $2,000 a month, and they ultimately impact the other remaining year brackets. Do you know what I mean?
Yeah. But I'm going to throw a couple other things when we were talking about affordability indicators here. The average Canadian now carries almost $21,000 in debt, excluding mortgages.
Yeah, so that's like high interest consumer debt. Yeah,
this is your line of credits, your car loan, your
credit
visas.
Cards.
That card you got at Best Buy, all of that stuff is now up to about $21,000. Monthly spending on credit cards increased 17.5% in quarter one, and lenders issued 31% more credit cards. So
that's the problem. I'm freaking out about this.
Totally. This is concerning. And so you've got the government that's raising. So this is the interesting problem. Everything's really expensive. So people are taking on more debt to try to afford it. And then the government is going to raise interest rates to try to
they're forcing a recession. They're not even trying to slow things down. They're forcing a recession.
Well, but it's a really hard situation because you're trying to bring prices back down through inflation. But as you inflate things, you have to realize we have a debtor consumer now. Like the consumers now are in debt. And when you raise interest rates, you are going to hurt them. And it's getting more expensive to live because of this consumer debt.
Here's the other way that I think people need to look at it that I don't know that everyone is. When they say inflation's like 7-8%, whatever it might be in a quarter, that's not only is everything you're buying more expensive. You're like, well, I'm not really changing my lifestyle, so I should be fine. No, your income also effectively just went down by 7 or 8%. Like it's the equivalent of like if you were making $100,000 2 years ago and you're making $100,000 today, it's like if you were making 80 or 75. Mm-hmm.
So this is also
not even including your housing.
Yeah. This is how they think they're going to slow the economy down. Because people are like, well, that interest rate there, how does that interest rate spike, how does that slow down inflation? So when you effectively hammer the value of the assets people own and you effectively increase the cost of getting access to money, i.e. like your borrowing costs, everyone just feels a little bit poor. And when they feel a little bit poorer,
they are a little bit poorer.
because they are a little bit poorer, and then they do not spend as much money. And here's another stat that I came across. In the last 6 months of interest raises, the average mortgage payment has gone up by, I've got this here somewhere, $790 in the last 6 months across the country.
The average?
Yep. And this is skewed because there's some big markets where those mortgage payments are gigantic. But also, during the last couple years, it's been something like 40 to 50% of new money mortgages have been variable rate. And so in the last 6 months...
So these are saying existing mortgages are growing by this much?
Yes.
Okay, so it's not just because everyone's buying new, more expensive homes.
No, this is existing products, how much they would have gone up over the last 6 months on average.
Okay, and just to double down, because we're just out here whipping on stats, and Chandler and I like doing our research separately, so we don't know what we're going to throw at each other.
Yeah.
So again, Chandler explained, again, due to like, without doing anything, as rates go down, it automatically increases your wealth if you own assets, because those assets are more valuable, because new consumers are going to be willing to pay more because they can borrow the money to buy them at a lower rate. So effectively, they're paying less to buy what you have, which forces its value up. So in this, and what ends up happening then is, by product, you end up feeling richer because you are richer. You technically have more money, you have a higher net worth, but it's tied to other things, right? It's like a stock valuation. Like Elon Musk one day is worth 250 billion, the next day is worth 200 billion.
Yeah.
It's the same concept on a smaller scale. And in this case, it's not just the news that's bringing down your value, it's also interest rates that are bringing down your value. So to double down, just so people understand what kind of amounts of money we're talking about, in USA, homeowner equity under 80% of their property's value. So under 80%, that's the tappable equity that you could use to borrow out and buy and spend and do things. Just in the first quarter of this year, so in the first 3 months of this year, rose by $1.2 trillion. So consumers in the US, 300 million people, their tappable equity 300 million people went up by $1.2 trillion. So that's $4,000 a person. Mm-hmm. And again, there's out of that 300 million, probably only 200 million own, on. So it's actually quite a bit more money.
So they feel flush.
So everyone feels flush and they're way more down to spend. And so this is why when we're talking about average prices going down by a certain percentage and interest rates going down by up by a certain percentage, it's massive amounts of swing that can change it, right? Like, I just want to throw that out there because when you're saying that, like, this is why people are feeling flush, because there's that much more money in the market, and now that's all getting pulled back out of the market.
Yeah.
It's being erased immediately, like overnight.
It sounds super depressing, but the idea is if people feel more poor in their day to day, because they are, as you point out, either through their assets coming down or their value of their property or interest rates, they will then go out and buy less, which means prices will come down. The challenge is prices are sticky. And what that means in economic terms is that they don't just voluntarily go back down. Once a price goes up, it is hard to bring that down because labor isn't necessarily just going to accept a lower wage rate, right? Input products may not automatically go down if there are other things at play. For example, oil costs. Right.
There's an inherent momentum to an economy that remains once this growth takes place that has to maintain, and that usually keeps the prices up for a lot of different reasons, like he's saying, like Chandler's saying, with wages, expected living styles, and even just like in general, like a city, once they expand and build all these networks and all these things, and they grow out the neighborhoods and all these new buildings, they don't just then be like, oh, we don't need this stuff anymore. We've shrunk our economy. We're just going to like cut off 10 square kilometers and stop servicing this part of the town, right? And so it feeds into this perpetual kind of...
Well, no one has really even thrown out the word deflation, right? Like prices come down. They're just hoping prices stop going up.
Yeah.
Right? The housing market and the asset market is actually going to contract, and they're trying to contract it. But this idea that like the prices may be the prices, they just will hopefully not go up as much, and maybe we're just going to have to live with it.
Deflation is scary too, because it can cause some serious... And just general like consumer confidence will be completely shot. As GDP, like all the businesses will shrink, layoffs become a lot more like, you know what I mean? People start to really pull back. One thing I want to add in there too, I know we've been kind of bouncing on this a couple times. On top of the thing I just said about the $1.2 trillion increase, the actual tappable equity pool in the States is estimated at $11 trillion, which is the highest it's been since 2006. And that's right before the last crash took place. Additionally, 75% of the borrowed money out there right now is at a lower rate than the current rate.
Oh God, yeah. So you're saying
what you just said, like
when those rates increase,
yeah,
there's
exactly.
gonna be repercussions.
There's gonna be massive repercussions because all the money right now is cheaper than what it actually should be costing, and additionally, like there is a massive amount of available money that again is still giving people that consumer confidence to buy and continue to invest, which will potentially get erased very quickly, which could cause, again, as far as potentially deflation. We're sounding like a very doom and gloom here.
No, but let's keep leaning into it. We're gonna pause here for a quick little pop quiz. This would be a great time to like and subscribe if you're watching online. But pop quiz, Neal.
Yes.
What is the most affordable province in the country to buy a home?
Oh God, it's gonna be like super contrary. They're gonna be like BC. No, it's gonna, Alberta.
Are you what? No.
Well, how they?
Sorry, average home
average
price.
price?
What's the cheapest home?
New Brunswick.
New Brunswick actually just became the second cheapest. They just became more expensive than one other province.
PEI?
Nope.
Newfoundland, Labrador.
Nope. Saskatchewan. So New Brunswick was always the cheapest place to buy a home until just recently. They just passed Saskatchewan.
Just to preface it, because I know a bunch of people are like, what's he saying with Alberta? No, the reason I said Alberta is because I assumed it was...
You said BC first.
Well, BC was a joke. Because
yeah.
right now all these weird stats are coming out, because I'm going to hit you with one here in a second now to follow this, but because they're going to be like, based on lifestyle, when we factor in the value of a hike at $30 million a hike, it actually equates that it's cheaper to live in Vancouver than it is.
And my buddy Eric posted this comparison of Alberta versus Nova Scotia and how much everything was cheaper in Alberta.
Well, and so I said Alberta simply because the average income is enormous. Like, I was just on the phone with one of my buddies who lives in Fort Mac, and he's like, I know they say the average income here is whatever, 130. He said, that is not true. It's like 230. And he's like, the reason it's 130 is because there's a ton of government workers and a ton of basically minimum wage workers that bring that average down. But he said, there is nobody at my company that makes under 180 grand a year. And we're talking like just general basic positions that are not necessarily specialized or anything. So that's why I said Alberta, because I was like, you know what? I know their housing is comparable to ours, but their average income is probably about 2.5 times ours.
Either way, for listeners in New Brunswick and listeners in Saskatchewan, you've now swapped. New Brunswick is the second least expensive place, and Saskatchewan is the most affordable place to buy a home.
All right.
So if you're looking to buy a home inexpensively, for New Brunswick, anyone who's curious, so the average home price that was just published in New Brunswick was $313,000, and it's gone up 141 grand in the last 3 years. So basically, it's doubled in 3 years, the cost of buying a home in New Brunswick.
Okay, I'm gonna hit you with a quiz then too.
Oh, all right, bring it on.
Money Sense did a list on where the best place to buy real estate is in 2022 based on cost and return on value. It's 45 cities.
In Canada?
In Canada.
Okay.
Who's number one? What was the best city to buy real estate in 2022?
Based on like return on investment?
Based on purchase price and the return on investment.
Purchase price and return on investment.
So effectively return on investment is what it becomes.
Ooh.
There's steam coming out of his headset.
Well, I mean, let's stay on the New Brunswick theme. Maybe Fredericton?
So close.
Moncton?
Moncton.
Damn it.
Moncton came first. Halifax, what do you think Halifax placed in that?
5th.
21st.
Ooh.
We took a big hit, which I was
Yeah,
surprised.
because we're expensive now. And we love our taxes.
Who do you think was last?
Oh, it's got to be BC. It's got to be Vancouver.
Vancouver came last, his best place, which is funny because most people assume like investors love to flock to Van City, but
They flock on the way up. They run on the way down. Fraser Valley is down 54% sales volume, last reporting.
That is psycho.
Yeah.
Number 43 out of 45 was Toronto. So it's Toronto, Oakville, Vancouver as your bottom three.
Yeah, worst return on investment. Interesting.
Those places make sense to build, but not to necessarily buy and just sit on the properties. But anyways, that was just a little one.
Now let's jump into, we're saying all these things of like why the government's doing this inflation, trying to slow the economy, trying to make people effectively be a bit more conservative with their spending. Now let's see if it's working. So quarter one, our GDP here in Canada was 3.1% increase. All right. It was expected to be about 5.2. So that means our GDP increased by 40% less than expected, roughly.
With an inflation of 7. Holy God.
Yeah. Like, so it's the GDP is contracting, inflation's still up, but that is a positive indicator for slowing the economy.
Yeah,
now they're attributing a lot of that to net import-export. In the States, first quarter, they actually had a recessionary report of minus 1.4% on their GDP. Like, so their GDP contracted, and they blamed it on the same thing. So you can already see this happening a little bit. With the housing market.
So scary. I got to interrupt. It's so scary. If people can think of like two lines in their head and GDP is like not increasing and inflation is like those are like very key indicators of like how much money is changing hands and how much things cost. So just think like if GDP is not increasing near the inflation rate, like that is meaning that somewhere there's a loss. There's a loss in that system, and those lines are going to cross back over at some point with aggression.
Well, like the inflation reporting is always going to lag some of these things, right? But
And that's true,
The
but-
reason we obsess over housing is because I saw this stat, and I wish I had it here in front of me. Over the last like 5 or 6 years, 85% of Canada's GDP growth has been attributable to the housing market.
Even sketchier.
Like that means the growth that our economy
We're
has
going negative.
over the last 5 years, the vast majority of it can be attributed to household spending, right? Real estate and household spending. And, normally it kind of is around 13 to 15%. So if that drops off significantly, it's not unthinkable to see these recessions. We got a lot of criticism out there. People like, there's not going to be a recession. This is blah, blah, blah. And I'm not saying that we will actually go into negative periods of GDP growth. Like we're still at 3.2 or whatever I said it was. That's still positive GDP growth. But like if that was the numbers reporting from January, February, March, which were still bull market,
Yeah.
what are they going to look like for these next 3 months where that we're intentionally pulling the housing market and consumer spending way down? Is it possible that our next quarter of GDP will actually be negative? It's hard because, month over month, this is the tourist time of year. It's going to be skewed, right? But
Yeah, but the tourist time of year is only going to impact certain specific cities. Like we'll do okay with it and all that, but like I don't necessarily think some of these inner regions of Canada are as heavily tourist leveraged. But I think this is a huge indicator, and why I think a lot of people who listen to this podcast agree with it, but maybe not everyone in general. And I don't think the general sentiment's there. But this is why other industries are so extremely important. And so you don't leverage. It's like everyone was like, oh my God, like Dubai is 100% leveraged on oil. And if that stops, they're screwed. And so they did an amazing job of going out and getting heavily into real estate, making some of the world's craziest real estate to draw on our real estate economy.
Yeah.
They went out and set up a bunch of stuff for tech. They hosted every tech conference and every big tech event, and they got all the companies to go out there and do that. So now they have a huge tech industry. And so they're like diversifying. They set up their financial industries there to service the Middle East. And so they did a big push on that. They have a ton of issues, I know, and they have a ton of human rights issues, blah, 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 on and on. I'm just stating.
Did you just blah, blah, blah human rights
I
issues?
didn't blah, blah, blah human rights. What I'm trying to
Human
say
rights
is,
issues, blah, blah, blah.
is that they made an effort on that
Do not take
front.
this out of
Yeah,
context.
exactly. Don't you encourage them to come at me.
Clip the video right here.
Yeah, but we have done, I think, a terrible job in Canada of this, honestly. On industry side,
I don't know what terrible is a fair.
what do you mean? We're constantly squeezing out every bit of industry that's out there. Anything that does decently well, we squeeze the living lights out of it
Oh, yeah.
until they leave. They get to a point where like it's not, and this is why we buy everything from the States. We have to cut our
we are
trees,
good
send them
about-
to the States, and then buy them back.
What do
We
you-
buy our oil from the States. Like we buy everything from out of town.
That, I don't think that's a fair criticism of Canada specifically when you're in a global economy now. Like people who rag on Canada for like the price of gas don't understand that like oil is set internationally. Like there's only so much that we can do unless we really go old school. We only produce for ourselves and blah, blah,
I
blah.
don't know, man. I crossed the border and the gas price drops by about 55% instantly on the first gas station.
Well, that is taxes though. That's taxes. That's
But
not-
55% is not just taxes.
Yeah, fair enough. Shoot, what was I going to say? You had me worked up about something, and I lost it. Either way, let's look at some other indicators of the economy slowing down, because the data stuff always lags, right? Like even housing reports, like things closing, like you don't quite
90
know what it's
days
going to be.
behind schedule.
Let's look at some of the things. So the Bored Ape Yacht Club, for those NFT lovers out there.
Chandler's buying a Bored Ape. As that market
Man,
crashes,
the
he's
bar
buying
market's
in.
60% down in May.
Yeah,
Down 60%.
But there's no,
not to be surprised.
There's no intrinsic. Someone respond to this. Send us a
Yeah.
video on TikTok. There is no value in random NFTs. There isn't anything.
Oh, you're gonna make
The technology has value.
Yeah.
But all these random little paintings
Stupid
and
apes.
pictures
Yeah, I
had
agree.
nothing to do with anything. Like,
But you
there's
can
gonna
make that argument about any art.
Yes, but this is like saying, okay, so paintings, there is a 0.01% of paintings that have a ton of value. The other 99.99% will have, and I mean dollar value. I'm sure there's sentiment or like value in your household,
cultural
and
value, yeah.
cultural value in those things. But I mean like trading dollar value as an investment. Only 0.01% of art has that value. Yeah. The other 99% is garbage, and so everyone just bought in because the news just talked about the 0.01%, and it was weird because it's electronic art. But most of it is pretty much garbage. But the technology
totally. Yeah.
has some really cool applications of being able to assign things, and also once the online, I think, in the metaverse world really starts to take shape and become more, I guess, widely used, NFTs will have even more value, I think.
I wish I knew that figure. Maud Lewis, there was a Maud Lewis painting auction that broke all Maud Lewis records dates. I wish we had that number because we're like these stupid apes, and then you just throw up this black cat.
This guy put up
with a puppy.
a white paint image on the internet and got 100 mil, and then this person, Maud Lewis, like amazingly talented, and they're like, yeah, I got 100,000.
I mean,
bucks.
is she amazingly talented?
Yeah,
oh my god, I don't want to go down there. Make people so upset. But
yeah, I didn't want to say anything, but
there's a little thing, that's reflective of some sort of economy in a weird way. But let's go into the big hitters. Your boy Elon caught some flack because he sent out this report and said that he thought Tesla was likely going to have to cut 10% of its salaried workforce.
Yeah, I mean, this is I like Elon for so many reasons because he just tells it like it is. I know he does some things he says that are a little offside.
I'm probably going to need to fire you now.
Yeah, exactly. Weirdo. But like but other companies will try and be super sly about it. Like this is my other thing. All these other companies, and I had this conversation. I'll think with my girlfriend, if she's listening, she's gonna laugh about like this ESG score stuff. Like there's companies on there that are way worse than some of the companies that are getting excluded from it. But they're just better at playing the game.
Oh,
that's all it is. I'm like, it's so funny that they also own the news company locally where all their plants are, and they're able to put
this is why I hate ESG.
Yeah, and Elon is just like, he's very straight up. He's like, look, the economy is pulling back. We've projected that things are going to slow down due to rates going up. People aren't going to leverage on our vehicles as much. All of our debt against all of our factories costs more. We can't get the materials to build. We have to downsize. And people are like, what's this guy's deal,
and
man?
That downsizing and the way he handled it
like,
will hurt his ESG score.
Like, doesn't 100%. Even he doesn't his is already screwed. Like he's not even on the list anymore. He doesn't count. Like he's
let's move into some other big hitters. Amazon, they also came out, and I don't know if they missed their earnings targets or not, but they came out and essentially told investors that they believed they were actually overstaffed currently. They went on pretty aggressive hiring for quite some time. Now they believe they are overstaffed. And we know what that means. If a company like Amazon's overstaffed, they're going to lay people off.
That's sketchy because they're like the second largest employer in the USA.
Are they really? Jeepers. Remember, we've been doing this podcast now long enough that we talked about the Great Resignation and like people just quitting en masse because like, you know what, I can get a better job and I'm going to do gig economy. Like
that was only like 6-8 months ago, man.
Totally. Right. And how hard it was to get people to work.
Now you're going to be wanting your job.
So
make yourself necessary.
This is why people are like, I can't wait for things to collapse. The Great Reset. It's like, all right, but like for some people that's going to be job loss. Walmart, they missed their earnings target, and Walmart doesn't typically miss earnings targets. And you
were saying that their warehouses are starting to fill up.
They're 33%. They have 33% over in their inventory because they ordered a bunch of stuff thinking people were going to buy forever, and some of it took a while to get there, so it all backlogged. They've got 33% excess of inventory, so they're going to.
How does Walmart miss that projection? I don't understand.
Man, it's a valid question. However, that's how quickly things have changed in the last 6 months. And if they ordered some of these Toshiba flat screens like 8 months ago,
there's gonna be some sick deals out there.
Well, they said they blamed it on a couple things: fuel pricing, the cost of fuel.
Yeah.
They missed their target also because of the excess inventory sitting around. But they also said, I think we might be a little overstaffed.
Do you think they said they had too many private jets?
Yeah, that's the last thing they cut. They got to keep those. So if you're looking at Walmart, Tesla, and Amazon, all basically saying, "Hey, we're overstaffed, and we think we're going to have to do some cost cutting measures here to hit our targets." Two things are going to happen: people are going to get laid off. But Walmart said we're also going to roll down some prices. So this is kind of
the old rollback commercials with the smiley face.
Oh yeah, this is kind of the central banks getting the result they want. And what people don't realize is the result they want might mean job loss.
The result that they want is full-on job loss. It's going to be a full-on recession. They are not just doing this to cool things off. They have to pull it back.
So
nobody likes Elon Musk, but if the central bank had Twitter, that would be the new public enemy.
So the Bank of Canada, one of their dudes rolled out there, not Macklin, not the main guy, but someone else, and he was questioned. And one of the questions was, will you continue to raise rates even if it puts us into a recession? And he was asked that question effectively twice. And both times he didn't explicitly say, yes, we'll put us into a recession.
But the answer is
both
yes.
times he said, our focus is to curb inflation and we will do whatever is necessary to curb inflation. which
Yep.
is a soft yes
Which
on.
is
We
a
don't care if
soft-
this is a recession.
Exactly.
Now, whether or not, you know, I don't know what'll break first. Their resolve, right? Like their willingness to do that, or inflation. Like I don't know if they can get this inflation under control with it. So.
It's not gonna be enough. Policy's not gonna be enough. They're gonna just keep going until it goes to a full breakdown.
Yeah, these are a lot of the negatives that are coming that are actually showing the slowing of the economy. But with that could be some positive. Like if you walk into Walmart now and that TV is cheaper, that is prices coming down,
Then
which is
you
what
can
we
go
want.
from a 50 to a 60 inch.
It just happens that they might have a staff cut. Another one is lumber is down something like 40% in the last couple months. Lumber, and then that hasn't trickled down to the consumer. If you go into Home Depot, Kent, whoever wants to sponsor this, if you go in there, those prices.
We're gonna bleep out whoever does it.
Yeah, those prices are still up because it takes about 6 weeks for them to clear their inventory.
Yeah.
Right. So they're still selling the product they paid full freight for 6-8 weeks ago. But lumber prices are now down 40% over the last couple months. That's going to trickle down to housing and to homeowners. But why is lumber dropping? Well, there's less demand for it. People aren't spending. Homes aren't being built. New developments aren't starting. So you're balancing all these things.
So just a thought here. This is a bit of an aside. Back to the central bank thing with increasing rates and wanting a recession. Little thought. Do you ever think that the central bank, like the government, part of them wants there to be a recession because what ends up happening is when there hasn't been a huge stressor on the economy in a long time, the general population tends to forget what it really means to run your finances properly. And so to teach their actual population, they force these things to take place. I know it sounds insane. But no, but seriously, right? Like it's like if we force a recession, this next generation is gonna consume in a much more controlled
here's
manner.
why I'm calling bullshit on that, because they're also the same people that like then they allow the banks to put out these consumer debt loans at higher rates than they should. I don't think that's the case. Because if they genuinely wanted that,
They're not backing the consumer debt loans though.
no, but they're creating a banking climate where they are allowed to do that. Like you could change the banking laws to protect consumers from themselves. If you really wanted to protect consumers from themselves, you could do it. We just happen to know that if you restrict consumer spending at a time when you don't want
The problem is in
then
a
your
place
economy grounds to a
like
halt.
the States, though, if you put in too much policy, you're going to have a full-out picket fence riot. Like you're going to have people going ballistic.
Yeah, but their banking market is super different there. Here, I think you could do it, right? Like you could make these things and put them in place.
I think they're trying to with the new down payment requirements, a lot of the different taxes that they put in place. I think they are actually intending to do that here. They're just forcing it. Like
I think the bigger conspiracy you could say is like, how come they put all of these restrictions on things when you want to borrow to put a roof over your head, but no restrictions on when you want to borrow to put a flat screen TV on your wall? That is a little bit, if you really, the mortgage is the least of someone's concern in terms of their overall consumer debt.
I think it's because on the small scale, it's not. There's ways to get around it being regulated as like loans and stuff. Because like these afterpays and that, they don't charge interest rates; they charge set dollar amounts. So they skirt the rules, and then it's a small dollar amount, so it doesn't classify into like a big enough category. Do you know what I mean? That being said, like you're saying, consumer debt is ticking up quite heavily, especially now with this whole. There was a transition actually. I was looking at this of
This
how
is a mess. I'm just
during
looking at
the
all this, it's a
pandemic,
mess.
like we used to spend on average 70% of our money on services and 30% on goods, and that basically reversed during the pandemic because services weren't being offered really.
Oh yeah.
And so then it all went to goods. And so this is where this
Interesting.
consumer debt concept kind of grew because then you could finance everything you bought. And then that's why we got this massive boom in basically Walmarts and Amazons and all that. But now that things are opening back up and the service industry is coming back online, merit because there's a lot of people who can make money off of that, like getting back into their work and getting their businesses going again. But then there's also lots of big guys like Amazons and Walmarts that are going to take a beating. So I think in the long run, though, I think there's going to be some good opportunities that come out of this. If you're in the service-based industry or getting into it, now might be a good time to do that because there's going to be another growth wave, I think, going back to that and a shift away from all the product stuff because I feel like online product selling was booming during this pandemic.
Oh, also things that like you would bring into your home and do projects there. This is part of why lumber went. I was like, oh, you know what? I'm going to do a little project on my house, in my house. I got nothing else to do. Well, now it's like, no, I can go outside and buy entertainment.
Yeah.
I'm going to spend my money on entertainment rather than these other things.
Yeah.
Yeah. This is just a total aside, but it caught my eye here. They rolled out like 9 million people in Canada got this like CERB advance for $2,000.
Yeah.
And they sent out 1.7 million notices saying, we're going to need that money back. You didn't qualify. So that means 20% of the people who got that initial $2,000 CERB advance. Is Neal texting someone right now to be like, the jig is up? You can't see this here if you're just listening, but Neal immediately got his phone.
I'm just sending a quick e-transfer. Give me a second. That's $3.4 billion? What did you say? 1.7 million people, $2,000. That'd be $3.4 billion.
Zero.
Dirty.
Yeah, so they're coming back almost 20% of the people that got it. And they're doing it at a time where, as we just mentioned, credit card debt is at an all-time high. Payments are up across the board. Some people might be losing their jobs if they work in Walmart. Like, this is the balancing act. So you say you want this dramatic reset. Here we go.
So, yeah, he's not saying me. He's saying just the people out there that are saying this. I'm nervous as hell with the dramatic reset. No, the reason I was opening my phone, I'm trying to find I had written down a little story here, and it was kind of, I find it kind of funny. Some people are going to probably hate me for thinking that it was funny, but basically it was that realtors in the States
I saw this.
received $3.9 billion in paycheck protection during COVID. While at the same time, the market absolutely blew up. And they pulled up a bunch of realtors because I guess they can see this. Yep. And like, this realtor sold $80 million in property. So if you average a 2% commission, that's $1.6 million. Or is it? Mm-hmm. Yeah, $1.6 million of earnable income. In the same year, he took in $81,000 of forgivable loans from the government. And people are like, how is this happening? And I know how this is happening. Realtors obviously are incorporated as their own businesses, and then they pay themselves a paycheck, right? So you personally aren't earning all this income. You have a real estate sales company that earns the income, and then you personally take a salary from your sales company. If for some reason your sales company decides during COVID, we might have to cut things back. They made that decision. You as an individual have now lost your paycheck, so you qualify on that technical clause that you qualify for paycheck protection.
I did not do this. Is this a thing that we could have done here in Canada?
I think you can get away with doing this here in Canada. I actually bounced this off our broker and had him like, hold up, does that mean if I just stop paying myself that I qualify? And he's like, well, technically. And I'm like, I'm glad I didn't do it. But 80% of these loans of the $3.9 billion were forgiven. They did actually NBC actually contacted a few realtors that they like could pull up their name and be like, oh, it looks here like you're online on Instagram. You said luxury top producer, and you seem to have a brand new Range Rover. But on the same note, we've also seen that $110K was wired to you on a forgivable loan. And all the people that they contacted said, yes, I had a great windfall this year and I've actually begun paying it back.
Realtors are definitely paying back that forgivable loan. If I know realtors. But all right, man. So we've talked a little bit about kind of how expensive things are getting and what we're seeing for actual signs in the economy that things are shifting. Because it's certainly happening. And now we're going to talk about appraisals, because this is something, as these house prices pull back, appraisals are becoming very what's the word? Interesting is a good word. So let's start off, Neal. Like, what is an appraisal?
Temperamental is the word, I think. But
so what exactly is an appraisal?
So an appraisal is what the bank requires to value your home. Or it's a third-party independent way of valuing your home. So you might think your house, there's always those memes you see, your house is worth $100 million. Because it's your house, and for you, it's worth $100 million. But unfortunately, on the market, it's not.
But even it goes a step beyond that, because everyone says my home is whatever someone is willing to pay for it. So if someone has written me a check for $1 million on my house, then that means my home is worth $1 million.
And appraisers don't agree with this, and they're more of a neutral party. They try not to have a vested interest in the evaluation of your home, and so even a lot of times it does have a huge weight. If you can show that you had potentially multiple people willing to give you $1 million, then an appraiser is willing to change their tune. But if one person out of the blue, like if Chandler just happens to buy my house for $5 million and it's only worth $200,000, the appraiser is not going to take that as gold, because at the end of the day, it's only one person. But if we had 5 random individuals show up at the same time with that same offering, they might be willing to value it at that, but they're going to figure out why. They're not just going to be like, okay, this house is now worth $5 million. They're like, okay, so the actual home is still only worth about $500,000, but the parcel of land that it sits on, due to its zoning capabilities or whatever it may be, is worth $4.5 million.
Yeah, they call that the highest and best use, and all these ways to measure the value of the property. But it's really interesting as the market's going up. All those appraisals just seem to hit the target.
So like when the market first got hot here, because we'd never really had it, some were missing.
Yeah,
People
some
were bidding
falling
over
short.
and they just kept kind of falling short because the appraiser's been here for 10 years. And he's like, I've appraised every house in the street and they're all worth 330 to 350. The nicest ever was 375. Yours is not the nicest ever and you're selling for 425. Unfortunately, your house isn't worth that.
Yeah, that was an issue early on, like call it like summer 2020.
Yeah, exactly. Right at the start. And then as we started to have some consistency to this growth, appraisers started to be like, oh, wow, well, first of all, this is terrible as it is. They don't necessarily get all the jobs if they don't hit the numbers that they need to get. So there is some pressure from externals. But then they also started seeing like, look, you know what? I came back to the same street. That one sold for 425 and his neighbor sold for 450 and the one next to him sold for 475. So now we have some comparable data.
And there's some trending weight that they're not really supposed to do, but they can kind of put it in there a little bit. I can't remember what they call the term when they can look at like the trend of the real estate a bit.
Exactly. And so that allowed them to then justify these new purchase prices. And so again, just to finalize, though, like, so an appraisal is basically, it's a third-party company that provides, it's supposed to be an unbiased valuation of a home or a commercial property. And in a house, they look at all your comparables, your surroundings, your location, the value of the land. And then when they compare it to your neighbors, they are going to look at the details of like fully renovated bathroom, half renovated bathroom, kitchen with dishwasher, kitchen without dishwasher. Like they will literally break it down to those points, and they're called like positive influencers and negative, and they'll be like, you'll see it in there. Positive adjustments and negative adjustments, and those will help to fluctuate kind of the price, and then they'll kind of boil out to an exact number.
The other thing to keep in mind is really important that the appraiser works for the bank. Even if you're going for a refinance and you speak to your lender and you're able to say, select your appraiser, right? That appraiser ultimately works for the bank and they're meant to be protecting the bank's interest. So why it matters is because the bank, if they're going to loan you, be it 300 or 500 or $1 million on something, they want someone to go in there and say, yeah, it's worth that.
Yeah.
And why this matters, we've always talked about why this matters when you're refinancing a multi-unit property and all these things you can do with cap rates and with rent to get the valuation of your property. It's the appraisal is a massive part of the BRRRR model. If it started with R, they definitely would have put it in there, but it starts with A, so they kind of skip over it and they just call it refinance, right? But like the appraisal is integral to all of this.
Reappraise.
Reappraise. So what's going on right now, and I've heard this anecdotally, but you're hearing it more and more and more, that appraisals are falling short of purchase prices. Upwards of, someone tweeted the other day that something like 40 or 50% of the appraisals in suburban Ontario areas are coming in under the purchase price. So say you've agreed.
Why are they making that decision now is the thing that kind of blows my mind. Because it's funny how
because they're getting scurred. Like they know that they're responsible to the banks and they're now trying to cover a little bit here because.
And they do carry an insurance and a liability when they provide that valuation to a bank. I don't know what exactly the agreement is, but that's usually why they're with firms, because those firms do carry some sort of, not a guarantee, but they basically are backing that valuation. And I think they carry a legal liability when they say a house is worth $1 million. The bank is saying like, okay, like if this comes back and we end up getting screwed on it, we can kind of chase you down for some sort of valuation. I think appraisal insurance is quite high for that reason.
Oh, I'm sure. And they're looking like, okay, there might be defaults here in the future. And if there's a default and the bank says, well, we loaned that money based on,
lost.
And we go to sell it. Now we can't recover the loan amount. And you told us it was worth that amount. Like they could be responsible for that. So why this matters for buyers is, say I agree to buy Neal's house for $1 million. The lender comes, they said, great, we're happy to finance the deal, but we want the appraiser to go in and assess the value. The appraiser goes in and says it's only worth $950. Guess who has to come up with the extra $50,000? The buyer. And look at some of these big deals. Fired. Yeah. Look at some of these big deals where it's like might be 1.8 and then only praises for 1.6. If you had that as a condition of your deal, which for a long time people had no conditions, right? But if you have it for a condition of your deal and it comes in $200,000 under, you either have to renegotiate or eat that out of pocket. So this is a huge thing that's going on in these major markets. I haven't seen it here locally yet. I find the appraisers are still, they're still hitting values because we haven't had any big major swings. But as some of these numbers get reported and prices go down, you're going to see these appraisers kind of covering and hedging a little bit and bringing the numbers down.
To what we've talked about before is how consumer confidence has always been that their neighbor's house sold for more. The second you see your neighbor's house sell for less, you kind of lose all that confidence. It's the same with the appraisers. I think the second now, a few of them have seen a few sales go through that don't beat the previous sale prices in the neighborhood, or they sell for slightly less than something that they have appraised in that neighborhood at higher, they're like, oh crap, my credibility, my insurance, my all those things goes up in the air.
Also, they just genuinely want to give an accurate, in the moment reflection of the value.
They're 100%.
Right?
And, to be honest, like, yeah, they're trying to give an actual value. And then the other thing to consider, so appraisals on the commercial side, cap rates are an extremely important part of the valuations. Cap rates take into account the expectation for interest rates, and with interest rate pressure creeping, the requirement for return is going to increase for people buying, and so they're going to buy at higher caps, and it's also going to show and push that current market cap rate that they use to appraise commercial properties up. So again, we're not seeing it yet, but if these rate increases sustain, this constant downward cap rate pressure that we faced may kind of swing in the other direction, which can have a huge impact on takeouts. Like 0.25% could result in millions of dollars on a certain building.
Just like an appraisal on your refi, the difference of 50 grand, if you're refinancing 80% loan to value, like that's 40 grand, which if you're starting out, that's your money to go buy the next one.
Yeah.
And we've talked about this before, like with appraisals, you try to be a little bit opportunistic. When you have that good sale on your street, you try to get an appraisal close to them because they need to use recent data. Well, what happens 6 months from now where all, the three best comparables are down, that's how you lose your equity, which then allows you to not go out and buy more, which slows again, this is what they're trying to do in slowing the market.
Would you recommend to people listening to get all their appraisals done right now and try and get some takeouts accomplished, or to wait, or what would you be your thought there?
I hadn't thought about that. I think that it's a good time to be liquid.
Yeah.
So getting access to cash, I think, is always a good idea. Also, a lot of these refinances you can do can be on a HELOC where you don't actually pay anything on it until you use it. So if you're worried about changing your numbers right away and paying a higher interest rate, like at least you can have this liquid. I'm getting the finger wag.
Finger wagging over here. Those HELOCs, home equity line of credit, right? It's a line of credit against the equity in your home.
That's one option.
Under 80%. I'm not saying it's not. I'm just going to throw this out there because I've had a ton of people ask me about this recently and said, hey, should I reappraise and get a HELOC? When interest rates go up, your debt service ratio is going to increase. The debt is going to increase. It's going to reduce the ratio. The bank reserves the right to then reduce that HELOC, whether you've utilized it or not. So if they open you a $100,000 one today and rate increases take, again, another 2 hits and the market takes some sentiment, the bank's saying, hey, we don't want to have this much liability out there right now where people are over leveraged and a bunch. We got 50 million in HELOCs where technically they're over the debt service ratio. We have to put out a mandate to all those branches to yank all those HELOCs back. And so I told a few people, and they said, look, if you really are wanting access to that capital, you might want to take it out on a mortgage amount, have the cash, if you really want to have it, understanding that your mortgage payment is going to go up and all those items. But it's better if you can get it locked in, because the things that they're going to close first are the HELOCs. They can also make you pay your mortgage down on a refinance. That's also possible. Sometimes just to refinance or just to renew your mortgage, you can technically have to pay in on that, and so that is a thing. But you're less likely to see that than I think HELOC shrinking. I think HELOC shrinking will be the first thing you see. It gets very easy for them to do.
So, what are your thoughts right now on getting appraisals and going liquid?
Yeah, man, pull it all out. Leverage to the top, 99% out. Appraise that bad boy for 125% when it's worth, and take it all. No, in all seriousness, so
I couldn't tell if you were joking for a bit there.
I'm like half joking. I'm half legit. Yeah, it depends on what you're going to do with the money. If you're not going to do anything with the money, you're not interested in investing it, and you're more of a conservative person, then no. I think carrying a low debt ratio on your home or your investment is really a good idea, and to be safe through this and kind of ride the wave. If you're an aggressive, and you believe mover and shaker kind of a person, I think now's a good time to get your max value of the property, take out a decent amount of money at still a fairly low interest rate,
and try to be opportunistic.
Lock it in and try and be opportunistic.
Did you say lock it in?
I would lock it in. That's the part of the no. You mean rate wise?
Yeah.
No. Sorry, I mean no HELOC. I mean actual mortgage product.
All right.
I don't like the HELOCs because I think those are going to get pulled back. But I would do mortgage product. Okay. The concern that I have, and the only reason I would even consider locking it in, and we're going to unpack this I think again later, is what I just said. So if you do a 1-year variable right now, and a year from now, if the rates are up another 2%, and the bank decides that your DSR is not great, you could have to give back some of that money on the commercial world. So you could,
okay.
So on a renewal, and a year from today, they could say, hey, I know last year, we're not giving you any more money, but actually to maintain a position in this property, you need to give us $100,000 back. And you'll see that more on the commercial side, again, less on the residential. And this is where the concerns are for me. And I think this is where they talk about a lot of commercial guys will get squeezed, is because 75% of the money out there is locked in and looking at renewals in the next 2 years. And they're going to come up with these rates. And if you're in a really high leverage position, you may have to pay down your leverage. And if you can't, you have to sell the property.
I feel opportunistic about the rates moving forward. But so let's talk about that as kind of our outgoing thing. Because I've had a lot of people continue to ask, are you going fixed? Are you going variable? And my immediate answer, this is not financial advice, is I'm going variable. And to try to unpack why that is, I don't know. We covered a little bit before, but the Bank of Canada rate right now is 1.5%.
Yeah.
Right. And they're meeting, I think, 4 or 5 more times through the rest of the year. The next one is July 13th. So a month from the day that this comes out.
Yeah.
They're going to meet again. And I hate to tell you, they're going to raise rates again.
Yep.
There's even been some little whispers that it's going to be 75 basis
I've heard
points
that.
instead of 50 basis points.
Yep.
And the reason they sneak that out and they kind of hint that early on is because you get all of the
Lessen the blow.
not only lessen the blow, but actually let the results. It's kind of like you put the fear in people and then they already act like the rate has already gone up.
Yep.
Right? So you get a free month of people acting like the rates are up 75 basis points, even though they're not even up yet. So rates are going to increase, and all projections. Someone asked earlier on Instagram or on TikTok where I thought they'd be at the end of the year, and I kind of thought they'd be like 2.25 to 2.75 or whatever. It looks more like they're targeting 3%, and that's where the banks have kind of set their end of year projections at around 3% for the Bank of Canada rate. After that, moving into the longer term,
It's so high. Sorry. I'm sweating.
It's not that high. Yeah, it is fine. But looking longer term, they being like the banks, and when they're setting their fixed products, are actually banking, no pun intended, on that rate stabilizing at 3% and even actually probably coming down, right? So they are building in an expected 3% Bank of Canada rate into the fixed products that they're offering right now. And maybe, I don't know what you're seeing out there for variable rates, maybe 3.25. What are you seeing for variable rates?
Yeah,
right
I haven't priced one out recently.
Okay.
I'm doing them right now.
But say 3.25 maybe for a variable rate.
Yeah.
And a fixed rate, you can maybe get 4.75, 4 or
On
5.
commercial money?
No, just residential.
I think. Well, it depends on your term. Because I've seen
yeah.
some fixed ones, 1 and 2 year fixed, that are crazy low. And I think
Like crazy low what?
Like 2, like high 2
What?
range.
No,
Yeah, I have a guy. I'm gonna double check and we'll fact check this, but I believe one of my guys came back to me yesterday and he had a 1 year or 2 year fixed term offered to him at 299 or something crazy. And I genuinely believe that they're trying to bait you to take that, because then in a year from today you're gonna have to renew at a much higher rate.
I disagree. I think and I was looking at a few products where they were actually trying to, what they're doing, they were moving it up on the shorter terms, because I think that if you take a 2-year product, you're going to be renewing into a much lower product in 2 years from now. This is why I think variable is going to outperform it. I mean, if we're expecting another 1.5% rate increase from a Bank of Canada, if we're expecting that 1.5% increase, maybe that means the variable gets as high as 4.75?
I think you're being optimistic with how quick they're gonna turn around.
You think it'll be longer than 18
Yeah,
months?
I think it's gonna be years that these are gonna sit like
Years?
this. Yeah, I think it'll move up and down 25 basis points here and there, and there'll be some slower downward pressure. But I think it's not going to creep up as fast as it's going, or it's not going to creep down as fast as it's gone up. And I think if we look in the past years, how many years did it take for us to get this low?
Yeah. No, that's fair.
Everyone talks this rate is, we're going to the rates of 2007.
It did take a pandemic to get it down this
15 years and a pandemic to get this low, and it's taken 6 months to creep this thing back up. It's not coming back this low that quickly.
Right. Okay, but still, but you do believe it's probably coming back down in the next 24 months, at least marginally?
I think it's going to stop cranking up in the next 24 months.
Okay. So has that changed your thoughts on locking in fixed versus variable?
Yeah, so it depends on your product. But again, I met with a couple bankers here.
But if you have an existing product, you would not be locking in at these posted rates, would you?
No. So for me, I met with some of the bankers here that do a large amount of lending in Atlantic Canada, and they didn't have great sentiment. Just sitting at the lunches, they were just like, I first see this being a multi-year thing, and it's going to take years and years and years after for it to come back around. And so, and I was kind of thinking that too. And my thing is, when you look at the rate charts, those are designed, they kind of tell you what's going on, right? When they're baiting you to certain years, they're in business. It's a game, man. They're trying to line everybody up to be stuck in these renewals at certain periods of time. And so I think your peak out rate point is going to be 18 to 24 months, because that's why these 1 year terms and 2 year terms are so much cheaper.
Yeah, man, but I've seen a lot of
ones.
I've seen a lot of 2 and 3 year terms that were actually higher than the 5 year.
Well, they're still
trying
gonna, but they're still going to.
they're trying to threaten you with like, oh, I mean, we can give you 3 years if you want some flexibility. We'll give you 3 years at a higher rate. But good news, we can lock you in for 5 years at only 5%. And I'm looking at that, I'm like, no, man, I'll ride variable and stay under 5.
I need to get a new
confidently.
sheet. I'm getting a bunch of banking stuff done right now. I'll see what the new sheets look like. But last time I had looked, I remember the 1 and the 2 years from a few of my clients too. They were cheaper than the 3 to 5 years, and I really think that they were trying to bait them in there, because if you go for a 3 to 5 year, you're going to run through the entire rate increase, so they need to make their money, so they're going to go after you there. For me, especially on my cheap wood frame product that has really no alternative value, I'm getting it finalized, capitalized as much as I can on rent, because I think rent controls are going to remain, and I'm doing as long a takeout and as long as a fixed term I can, as long as it cash flows and makes sense to me, because I don't want to be in a position where the renewal comes and I got to pay back that bill. And I genuinely don't believe that there's that much upward pressure left on a lot of this older wood product when you're getting it valued today. In the short term, I think in 5 years from today, it's going to be another thing, and there'll be another run into the 5 to 10 year mark.
So you're not going to try to refinance or top those up in the near future?
I'm going to do it all right now,
Yeah.
and I'm going to sit on it. And I'll still be able to refi. Even on a fixed product, I can still go back to that same bank and get a
top
refi
up,
is my thing, right? That bank will still offer. And I asked him, I said, can I come back to you for refi? And he said, yeah, just don't come back to me for 30 grand. But this was also a $11 million refi. So obviously I'm not going to go back for that. He said, make sure it's a 7-figure refi and we'll do it. And so for me, I'm going to take out the maximum amount of money right now, lock in for as long as I possibly can, amortize the hell out of it, and just run my cash flow. I don't suspect that I'll be able to go back for more, but maybe.
Are you able to share what rate you're being quoted?
I'm doing it right now. So once I get it, I'll share it.
All right. That's something we can unpack in a future date.
Yeah. But anyway, so thanks for listening. We had a bunch of doom and gloom. We had some ups, some downs. Again, we really appreciate you guys all tuning in. The appraisal stuff I think is interesting. So hopefully you guys got something out of it. If you had some more questions, let us know. I'm super curious to hear people's thoughts are on this, like the market turning and stuff like that. Like, I don't think everyone's like, oh, you're trying to sell doom and gloom, but I don't think it's trying to sell doom and gloom. I just think that is where we are at today.
Yeah.
Right. Like,
you know what I mean?
it's
this is the reality. Just we're selling like pure optimism 12 months ago.
Exactly.
You know?
But that's where it goes with this market.
If you've listened to this point, can you comment? I'm just curious, like who's listening out there still to the
When
end
there's
of the
no
YouTube
comments, I will cry.
video? Yeah. That's the YouTube video.
But
So,
all right, I'm going out to look at Oasis of the Seas. I'm taking a kayak to go take a peek.
Yeah, I gotta go show an apartment. So let's
And
get out of here.
Chandler's showing an apartment. So thanks for listening.
Later.
Like, subscribe, comment.
Thanks so much for watching the episode. I hope you enjoyed it. If you did, press like. Don't forget to subscribe. But also check us out on Instagram and TikTok. You can find all the links below. Thanks again for checking us out.
When I was broke, I had rich habits. When I was broke, I had rich habits.